Hello, this is Alan Kendall, and this is a graph I got out of stockcharts.com. Stockcharts.com. It's a perf chart, and what it is these are all the Amex spiders, the financials and energy and utilities and industrials, and I added one here, which was home builders. This aquamarine here is home builders. This is for 6 years, and we see that home builders have underperformed the market, and so have financials underperformed the market for 6 years. And the reason for this, that this underperformance, is that when we look at this next graph, we see that this is a graph that was made by Credit Suisse, and these green are the subprime loans that started adjusting way back in 2006, and 2007 and 8 primarily were $1 trillion of subprime loans. And then in 9, 10, and 11, these primarily in 10 and 11, the subprime, the more loans, two more loan packages, the Alt-A and option adjustable rate loans, also called the option ARMs, these orange and peach here, they were 1.6 trillion, and they adjusted. And these are adjusting from 2006 through 2012. And this is the reason that the financials and the home builders have been hurting, is because a lot of these loans were defaulted on and caused a lot of short sales. Short sales are very, very depressing on the market because they're distressed sales that are sold at really below market value, and they push the prices down. This next graph here is just a 3-month instead of a 6-month. If we look at a 3-month graph, we see that the home builders and the financials and technology are leading the market in performance, and those are really the places to be, because just a little bit of movement in like XHB and XLF, which are between between like 14 and $20. These just a little bit of movement in them should cause a big rally, a big percentage jump as compared to a higher mutual fund that is much higher priced, and so we can expect that. Here's a graph of the Nasdaq, and we can see that the QQQ is breaking out to higher ground here. It actually has a technical breakout above the Bollinger Bands, and it has broken out above resistance. And so this shows us that financials, home builders, like a financial mutual fund like XLF is very safe, and also the mutual fund XHB that we saw plotted there is also very safe, very beat down, and the earnings of the home builders should turn around as housing picks up. Also, we see this technical breakout in technology. Technology is still beat down after the dot-com bubble, where it lost a tremendous percentage. And we can see here that it's on this weekly graph. We can see this very positive breakout here, where the MACD is positive, and we see the breakout in price. These are very positive. And if we look at some of the home builders, I did this graph of home builders. I used the Warren Buffett's secret value formula on them, and I found out that many of the home builders have have negative earnings. Their price to books aren't really that spectacularly low. I don't see any of these below 1 here, and so their ratios come out average and poor. Many of them are average and poor. When I did this on financials, I was able to find 5 financials. Barclays with a 12% earnings and a price to book of 0.55, that's selling for about half of the book value, has a score of 26, should go up 5 times in price. Bank of New York, Mellons Corp, also 17% net earnings, selling for 80% of its assets, also has a score of about 25, should go up 5 times in price. Citigroup, this is just the C. They also have a 14% net earnings, and selling for 54% of their assets. They have a score of 27. Bank of America only has a 1.5% net earnings, but they're selling for 37% of their assets. They have a score of an average score, but I put them in this group because their earnings are going more positive. Zion's Bank Corp, they have a 14% net earnings, selling for 52% of their assets. They also have a score of 27. So these have excellent scores, and when you look at their 10-year graphs, Barclays is 1/4 the price of what it was. It's 1/4, and we have Bank of New York is 1/2 the price. Citigroup is 1/17. C is 1/17 of what it was, and Bank of America is 1/7 the price of what it was, and Zion's Bank Corp is 1/5 the price. So technically they're beat down, and also fundamentally you have some very good earnings here on 4 of these stocks. Only Bank of America has weak earnings still in early 2012, but they're going positive. So maybe they'll go much higher in the next year. So I've selected these as 5 stocks that actually could make some dramatic moves. These stocks could easily double, quadruple, quintuple, go up 7 times. C, I think, will only go up about 5 to 6 times. I don't think it'll go back up 17 times. I think it'll only go up about 5 to 6 times. And so this is why I prefer financials, XLF, over the home builders, just because I can find a few that still have excellent earnings and should rally very well and be strong in after 2012.